So it's about, I believe it was a $40 million deal. And we, as a whole team, we had to come up with about 15 million. It's like LTV is about a little bit less than 70%. I believe it was around 68, 67.
This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. Today, my guest is Jim Lee from Formosa Investing. Jim is a syndicator. He's involved in multifamily syndication deals. He's always on the lookout for the next multifamily to invest in, primarily in the Sun Belt. Jim, welcome to the show.
Hi, Gabe. Thanks for having me.
Absolutely. Yeah, Jim, first question is, you are now a full-time active investor in the multifamily space. Maybe take us through how you got started in this. What did your first real estate deal look like?
Sure. So I got my economics degree at UCLA back in 2010. I started working my career as an inside sales representative for Loopnet and CoStar. And from there, I kind of spoke to a lot of property managers, real estate agents, lenders, and so forth. So I learned the importance of having multiple stream of income because I talk to investors pretty much majority of the time. And from there, I started studying real estate, investing in real estate. And my very first deal is a 2-bedroom, 1-bathroom condo out here in Ontario, California. And after, getting that passive income, I was pretty hooked and never looked back.
Awesome. It's quite a big leap, Jim, to go from owning, say, a 2-bedroom condo to getting a whole bunch of investors together and plopping down several $1 million on a large multifamily. What did that journey look like? How did you go from owning one investment property that's a 2-bedroom to closing on your first multifamily deal?
So after I acquired 2-bedroom, 1-bathroom, I was actually laid off not too long after that because CoStar acquired Loopnet and then kind of just started to laying people off from Loopnet. And so I transitioned to become a realtor thinking that I can find my own deals, but it's not as easy as I thought. And I was also trying to make a career out of real estate. After doing it for 2 years, it wasn't a good fit. So during lockdown, I started studying syndication. I started listening to podcasts, went on YouTube to educate myself about the space because I was exploring options on what I can do with real estate besides being a realtor. And so from there, after we had opened back up, I went out to network in Texas, Florida, and so forth, found my business partner, and essentially was able to syndicate my first deal from there.
That's amazing. Yeah. And just for those who don't know, Loopnet is an online marketplace for multifamily type properties, correct?
Correct. It's basically Zillow for commercial real estate.
And Jim, what did your first multifamily deal look like? How big was it?
My first multifamily deal is my very first syndication deal, which is a 200-unit apartment building in Orlando, Florida.
Wow. Okay. And if you don't mind me asking, how much did it cost? How much cash did you have to put down? And what did the whole financing and the whole deal look like?
So it's about, I believe it was a $40 million deal. And we, as a whole team, we had to come up with about 15 million. It's like LTV is about a little bit less than 70%. I believe it was around 68, 67. And it's a Class C value add apartment building built in 1972. And the projection is to hold the property for 5 years. If we can refi in year 3, that would be ideal. So far, we closed that deal since July of last year. We've already renovated 1/3 of the apartment units in the complex. So things are going really well, but our marketing hasn't catch up. So there's a bunch of units that's currently not being leased. So yeah, so with real estate, there's always problems. Just how you put out the
Absolutely,
fire.
absolutely. Yeah, that's what makes it challenging. So, Jim, tell me, how many years did it take from the time you got your first two-bedroom condo to the time that you closed on your first multifamily deal?
The timeline.
Like, how many years did it take? Yeah.
Yeah, so I closed my very first deal back in 2015. That was the very first real estate deal, and then from there, I wanted to acquire more, but for some reason I didn't take action because I was still exploring the possibility of a partnership instead of doing everything on my own. I knew that, I didn't, I want to continue to add more real estate to my portfolio, but make it passive. I didn't want to. With my first condo, I managed everything, from A to Z, from, finding tenant, collecting rent, doing the maintenance all by myself, just to cut costs. So I wanted to explore options of making it completely passive, and that's part of the reason why I got into real estate syndication.
I see. And I had a chance earlier today to check out your website. It's called formosainvesting.com. And on that website, Jim, you indicate that your target return, cash on cash return for your investors is between 8% to 10%, and your target IRR is about 15%. Walk us through a little bit how those returns are achieved, and how do you know when a right property has the potential to give you those kind of returns?
I think with the way how the market is, you definitely have to look for opportunities that provide value add benefits, right? Like there's, whether it's, the units is not up to date, or the building is not up to date with newer paints required, or more amenities can be added to the facility, any possible way to increase the income of the property, that's when it's a good deal. And it also provides a little bit of insurance, because if you take over a project and you just not have that component to it, during downturns, you might not be able to recover as much, right? And not only that, by adding value, you also generate more return on investment for your investors, and that's where the upside comes in. Because the reason why we hold it for 5 years is to make sure that we're able to provide the 2x equity multiple for our investors at the end of this journey, which is the upside part. Not only are you getting the 8% cash on cash return on your first years, 2 years, or how many years that we end up holding the property, you also get an upside once we sell it. And that's where the 2x equity multiple comes in.
That's amazing. So it sounds like when you acquire a property, your plan is like a 5 to maybe 7 year time horizon, at the end of which you either refinance or you sell the property, right?
Yep.
Got it. And so it sounds like you're looking for properties where you can increase the value, like by basically upgrading the property. And by upgrading the property, you can increase rents. If you increase rents, you're increasing the net operating income. And if you increase the net operating income, then you increase, obviously, the whole value of the entire apartment complex.
Yep. And not only that, appreciation alone for holding a big complex like that is also going to be working with us along the journey. So you have to also consider that as well. But we don't usually, we try to put a very conservative measure on that too. Like rent increase, we underwrite 3% a year, even though in the past few years has gone, more than 10% or even higher.
Right. And where are you looking at properties currently?
We're currently looking in Florida and Texas.
Florida and Texas.
Mm-hmm.
Got it. And right now, what does your typical investor look like? What is your typical investor profile?
My dream investor is anyone between ages 25 to 60. But if it's more targeted, I would say 30 to 50, just because, they I'm targeting specific. My niche is basically Formosa, which is my company's name. It's mainly for it's not just for Taiwanese investors, but that's my niche, right? Once you see the word Formosa, you kind of recognize that, okay, this guy must be from Taiwan. So from there, I'm planning on expanding my network. Just whoever decides to invest with Formosa Investing.
And what is your long-term mission and goal, Jim?
My long-term mission and goal for syndication, I would say, Formosa Investing's mission is to educate and bring value in the form of syndication. It's, in my opinion, it's the safest and fastest track to reach that reality of financial freedom. Formosa Investing's vision would be something like to make sure that everyone who is part of Formosa Investing will improve their financial life tenfold, so they can focus on reaching their dreams and not the next paycheck.
Got it. Got it. And tell me, when someone invests with you, how active versus how passive is this investment?
I'm sorry, can you repeat that?
Yeah, how active or how passive is the investment? For example, if somebody invests with you, are they completely passive, or do you involve them in the decision-making process at all?
So it depends, right? If you come in, so there's two types of people that ends up in this kind of real estate syndication investment. One would be called considered a general partner. The other would be considered limited partner. As general partner, they're the people who's responsible to raise capital, to find a deal, underwrite a deal, manage the deal, and sell the deal. So they're the operator. The limited partners are the more that's just, as an investor, they just put in the money and they get returns. So they passively invest with, but they don't really have a saying in, managing the deal, so to speak.
Got it. Jim, tell us a little bit more about your website. I understand that if someone visits your website, there's a free ebook. There's other great resources on there. Tell us more about what people can learn by visiting your website.
Yeah, absolutely. So on my website, like you mentioned, there's a short ebook that they can download. It's 20 pages long. It talks about basically my own personal journey as a real estate investor, the mistakes that I've made throughout my journey, and how overcoming these obstacles kind of paved the road for me to become a real estate syndicator. And there's also due diligence checklists. If you're new to investing, especially real estate investing, there's another checklist that you can kind of download, and it basically just gives you like fundamentals of real estate investing vocabulary. Once real estate 101 crash course, I would say.
Excellent. Jim, tell me, what are some of the biggest mistakes new investors make when they get into real estate?
I would have to say trying to time the market. I think everybody tries to do that. But nobody has a crystal ball, right? If we do, then we would all be super rich. But the reality is, with interest rate, with what the Fed is going to do, with the supply and demand, with so many variables out there, with how the economy is looking, there's just so many things that you got to consider. And at the end of the day, if you just continue to hold on to your cash thinking that the market is going to crash in about a year from now, you might as well just get in right now, because the sooner you take action, the sooner you're allowing your money to make more money for you. You have to think of it that way. You have to be able to change out of that mindset that if you hold on to your cash, you'll always be able to find the next big deal, right? Waiting for the next crash. I think Warren Buffett mentioned something about the cost of average, right? Like if you invest, sure, you might not invest at the dip, but you're also gaining experience and building relationships, and you're working towards the bigger goal, the bigger dream, or so don't wait, start now.
Yeah, I agree. I think it's good to get a good deal rather than wait for a perfect deal.
Mm-hmm.
And
Absolutely.
whether it's real estate or stocks, it's almost impossible to time the bottom, right? I mean, if there's a good deal, get in, invest at the good deal. I mean, yeah, maybe it'll go down a little bit lower, or maybe it won't. Maybe it'll start going up, right? You would never know that you are at the bottom today. All you know is that all you can do is evaluate, is it a good deal or not? If it's a good deal, I agree with you. It's better to be in the market than just to wait on the sidelines where inflation is just eating away at your pile of cash. So I agree with you on that one. And
Yeah.
Jim, if somebody's just starting out in real estate, any advice that you would give them? What is a great way? Maybe like, I'm not going to put words in your mouth, but what kind of advice do you think would you give people? What's a good way to start out?
I would say just start out to educate yourself as much as you can, I think like the easiest way, the free way is definitely just go online on YouTube, listen to podcasts, and read books, right? And if you have money to invest in yourself, then definitely go out and network, go to events, go to your local real estate clubs, make one if you don't have one, and join mastermind groups, spend some money to be part of a mastermind group and, surround yourself with like-minded people, and you'll see that it's going to pay off in the long run.
Absolutely. Jim, are there any books or podcasts that you recommend?
Well, I started out learning about real estate syndication through the Real Estate Guy radio show. It's run by two gentlemen, Russell Gray and Robert Helms. They've been doing syndication for, I don't know, 20, 30, 40 years. They've been in the industry for a very long time, very successful. They invite, just all sorts of real estate experts, from, anything, anywhere from residential to nursing homes to commercial real estate, multifamily, industrial. So they always pitch about learning about syndication, and they got me into syndication pretty much. So that's one podcast I would suggest. Bigger Pockets is another good way to start. It's one of the, I think it is the most popular real estate podcast out there. So they invite, people from, from beginners to experts on the show. So you'll be able to learn a lot from that. Books, I would say that currently what I'm reading is what is it? The Power of Connection, a connector. There's this How to Be a Power Connector,
Interesting.
by Judy Robnet, and it's basically just utilizing your own network, be able to go out and network and find the people that's you're going to be able to add value. So eventually you create like this circle of influences that's going to help you when you need something, right? It's about adding value first and then build relationship that way to continue to grow your network.
Yeah, I mean, if we're talking about books, I just recently finished reading this book here. It's called The Perfect Investment. I think the author's name here is Paul Moore. And it's really cool. Actually, this book is all about multifamily. And there was one thing in the book that really kind of resonated with me and kind of drove it home was that he quotes this 20-year return. You probably can't see the chart there, but this is a 20-year study. Commercial real estate offered the highest return to risk ratio out of any other investment type, which is really cool.
Yeah.
Yeah. So, I mean, when I saw that graph, and I mean, obviously he goes into more detail in the book about the study, but it's really cool because it highlights the fact that you don't have to take as much risk in real estate as you do with stocks. And there's a lot of people who, I mean, making money in the stock market is very difficult. Like if you're going to be a retail investor and you're going to go out there and start investing in stocks, when you have your little brokerage platform, it's very difficult because most people lose money when they first start out trading stocks. It's because it's very counterintuitive and you have to control your emotions, etc. And it's very anxiety inducing. It's very stressful to see your portfolio go up and down because it's updated minute by minute, right? You know exactly how much money you made or lost in the last 2 or 3 minutes. Whereas with real estate, you invest in a property, you don't have to worry about that minute by minute update. You don't even get like a month by month update, right? I mean, you can hold that piece of property for like 5 years and not really have a definitive idea as to what it's worth until you go to refinance or sell it, in which case you have to get an appraisal. And so you don't have to worry about those ups and downs and those dips, because really it's a property, it's cash flowing, and you don't get that minute by minute feedback that causes so many people to stress out and panic and make wrong decisions. So yeah, it's definitely an important asset class to add to any portfolio, which I guess leads into my next question is, in your experience, if somebody's a passive investor, right, and they're investing in real estate and stocks and maybe some startups and a whole bunch of other stuff, how much of someone's portfolio should be real estate?
Since I'm a real estate investor, I'm biased. I would say at least 50%. Well, here's the thing. It's a good question to ask, because in my opinion, just like any other investor, you should diversify your portfolio, right? But for me, I've always made money with real estate, and it's because of the fact that I've lost money in stocks that kind of prompt me to want to invest more in real estate. And because just like everything you mentioned, right? Not only that, what I can add to it is just real estate is it's more scalable, right? Whereas like in stock, you can scale it, but it's in my opinion, it's very manipulative, and it's not as controlled as it can be, as if you were to own this piece of property. But not only that, the leverage part too, right? When you leverage with real estate, you reap the benefits of appreciation on the total asset value while only having a small percentage of your own money in the deal. It's the concept of OPM, other people's money, right? Like you mentioned, cash flow, the demand is there, affordability. We have affordability issue right now. And I think the most attractive part about real estate also is the tax advantage, right? Depreciation, tax write-off, tax deductible mortgage interest rate, and plus when you refinance, you don't have to pay tax on that money. So anyway you look at it, I think real estate is a must-have. That's why I would put at least 50%.
Yeah, and real estate is the number one way to get wealthy in America, and that is, if you know that this has been studied. Actually, I have this other book here that I'm currently working through, right? The Millionaire Next Door. It's a little bit old. It was written in the 90s, but what the author did was he interviewed hundreds of millionaires. Like it took him a couple of years to get all the data, but he basically looked up who the millionaires were in America in the 1990s and he interviewed them, right? And what he found was that most of them became millionaires through real estate. That was the number one avenue, right? More than stocks, more than starting your own business or whatever. It was real estate. And it's for all the reasons you just mentioned, right? Is the tax advantages, the cash flow, the appreciation. And I think most importantly is what you mentioned, is the ability to use leverage, right? I can go to a bank and I can buy real estate with 20% down. There's really no other investment where I can do that. I can't go to a bank and say, here's $20, can you give me $100 worth of stock? You know, the bank's going to laugh you out the door, right? I think the best kind of leverage a broker can give you is like margin of 50%, right? If I put up, to use the same analogy, if I put up $66 of my own money, the brokerage would lend me half that with another 33, so I can buy $100 worth of stock, right? It's still nowhere near as leveraged as real estate. And so when you put it all together, real estate is probably the number one way to reach your financial goals. Although I would agree with you is that, yeah, you probably don't want to put all your money into real estate. You want that to be a part of your portfolio. And then you also want to kind of diversify into other areas.
Mm-hmm. Mm-hmm. And also in my industry, I've noticed that especially boomers, they like to have, once they've built enough wealth, all they think about is how to keep them, right, rather than making more. And it seems like majority of them are turning into real estate, and there's a reason behind that, right? If they've lived their life and they know that real estate is going to be able to provide them stability, that's a sign that we're somehow, all of us are going to end up reinvesting in real estate one way or the other.
Yeah, that's actually a very good way to put it. And yeah, I mean, I think real estate is one of those where a lot of people are just comfortable with it because we all live in houses, or we all have roofs over our heads. We all know what a toilet or a faucet looks like. Most of us at some point learn how to use a plunger, or what it takes to how much it should cost to replace a window. So these are investments that people are just naturally familiar with. This is not some crazy thing like buying $200,000 of like gold futures on the Chicago Mercantile Exchange, which is this highly abstract concept. No, houses are real, they're tangible, people understand them, they're comfortable with them. And so I think it just naturally becomes an investment for people.
Yeah, absolutely. Like once you get into real estate, even if you just own a home, you'll understand like, okay, this is a safe route to invest.
Jim, what is your personal outlook on the real estate market? I know that there is a lot of people who are saying that, we're heading into a recession and all these high interest rates are going to crash the market, et cetera, et cetera. I think you alluded to earlier that rather than try to time the market, it's good to find a good deal and just go with it. But do you have an outlook on the real estate market, whether it's residential or commercial, over the next year or two?
I would say interest rate is probably still going to raise throughout this year, even though some people have predicted that it's going to come to a stop, probably till the end of this year. That's my prediction. But it's because right now what I'm seeing is that in the market, in the commercial real estate world, is that sellers' expectation still has not come down. I mean, buyers still wants to buy, right? There's buyers that still are looking for deals to purchase, but with the interest rate going up, the price has to come down, but the expectation isn't there yet, and so there's not enough velocity, no deals being made, and so my thing is, my prediction is it's probably going to be like this for the rest of this year until next year. Then we'll probably see some changes, moving forward, and I think the price will not come down. It's not going to come down to a point where if you're expecting a crash, no, that's not going to happen, in my opinion, because we have affordability issue where we're still low in a supply. There still needs to be a lot more houses that needs to be built, and we're not keeping up with the demand. So,
do you believe that there's a structural supply-demand imbalance?
There is.
And is that in all markets in the United States or just specific ones?
I believe it's across all over United States. We're short on, I believe, about 4 million or 5 million houses total. Yeah, and that's based on the U.S. Census Bureau data. So there's I mean, it just depends on the market too. I know that in California, well, you're from California, we're now letting pretty much any house build an ADU in the back, right? They passed that law, and it's to combat this affordability issue. Even in some counties, if you have a piece of land, you can build 10-unit apartment building, which is kind of absurd in a residential area. But I think it's just county by county, it varies. So there's a lot of things going on in LA. That's you can tell that there's a lot of affordability issues.
Absolutely. And here in the San Francisco Bay Area where I live, the affordability issue it really is extreme, right? There's just so many factors here in the Bay Area, not only the economy, but also just geographically, we're kind of boxed in, so we can't expand, right? So we're kind of boxed in by the mountains on the east, the ocean on the west, et cetera. So there's nowhere else to build. And so, yes, people are looking at ADUs. People are in some areas, knocking down houses to build apartments, et cetera. But even then, right, there's, in the Bay Area in particular, the supply-demand imbalance is so acute that rents are just absolutely incredibly high. And so I think anybody and everybody are looking at options to save money on housing, whether it's moving farther away, if they can, or trying to, like I said, add an ADU in the back or whatever options they might have. But it's tough, especially here in the Bay Area.
Yeah, and not only does that what we're talking about happening, but with the house pricing, not coming down as much and interest rate being so high. So now it's kind of like it's harder for buyers to buy, right? And when that happens, we're gonna have more renters. So there's going to be even more demand for renting. So, so there's that's why I don't believe the price is going to crash, even though there's a few speculators out there that is predicting that.
And Jim, what is it about the Florida and the Texas markets that that you find so appealing?
I think it's just you have to pick a market that's more landlord friendly, business friendly states, right? I've seen, a good amount of investors who got screwed out here in Los Angeles because of eviction moratorium. It really makes investors think differently. As an investor, I'm a real estate investor in California too. I love it here, but sometimes you really need to live where you want and invest where the number makes sense at the end of the day, right? So Florida makes sense because not only is it landlord friendly, but it's also, there's population growth, job growth. People from California and New York are moving to Florida. It's a alternative sunshine state for Californians. And so, living out there, there's job opportunities out there. And plus, it's a win-win, right? If there's demand out there, that means, we'll have greater success syndicating deals out there. And because it's going to push out the price, over time, appreciation and so forth. So it's just better return on investment for our investor. And that's why we decided to syndicate out of state.
Yeah, and that's exactly the reason why I invest in the Midwest, for the same reasons, right? So I'm kind of, it's early days for me in terms of my real estate journey. I currently own two single family rentals, and I co-own two other ones with a business partner of mine. And it's all in the Midwest. So it's basically Wisconsin and Pennsylvania for very similar reasons. Yeah, it's just I'm not excited about investing in California for the same reasons as you mentioned. It's just not business friendly, and the cash flow and the numbers don't make sense here in the Bay Area. So yeah, and there's a lot of people here in the Bay Area who actually make their money here. They rent here, but then they go and invest somewhere in the Midwest or in Florida or the Southeast.
Yeah, it's becoming more and more common. I know a lot of real estate investors in California, they still want to invest out here because the upside is so great, right? I mean, if you just invest in a property, even though if it doesn't cash flow, you hold it for a good amount of years, it's going to, double, 3x, 4x, I don't know how many x of your money, but, more people are definitely considered out of state now.
For sure. Jim, tell us more. Where can people reach you if they want to find out more about your syndication deals, your website, etc.?
Yeah, so my website is formosainvesting.com. On there, you'll be able to download my free ebook as discussed earlier this episode. And then you can also find me on any social media platform, Facebook, LinkedIn, Instagram at Formosa Investing.
Fantastic. Jim, I really appreciate you spending the time with us today. And yeah, thanks very much.
Thank you again for having me, Gabe. It was my pleasure to be on the show.